Legal disclaimer. The content presented in this video is for educational and informational purposes only. It does not constitute legal, tax, or investment advice, nor should it be considered a recommendation or guarantee of any kind. Viewing this video does not establish a client relationship, and no part of the video should be interpreted as a personalized tax filing strategy, investment recommendation, or contractual offer. We are sharing stories and examples based on real-life experiences of our part-time and full-time partners, illustrating how they may benefit from existing IRS rules and the U.S. tax code when operating as independent contractors. All tax-saving strategies discussed are derived from publicly available tax laws and regulations, particularly those applicable to 1099 self-employed individuals. We encourage viewers to consult with licensed tax professionals or financial advisors before making any financial decisions. We are deeply grateful to the IRS and the U.S. tax code for creating opportunities that empower everyday people to build businesses, support their families, and serve their communities. This presentation reflects our mission to grow, serve, and invite more partners to join us in bringing peace of mind to every household we reach. Thank you for watching and learning with us.
Hi, welcome. I'm so glad you're here. Let me ask you something right up front. Are you the kind of person who's been working hard, doing everything right, but still feels like you're not getting ahead financially? You're not alone, and it's not your fault. The truth is, most people were never taught how the tax system really works. They don't realize that the difference between a smart taxpayer and a struggling one can come down to one thing: strategy. That's what today is all about. We're going to walk you through powerful legal tax strategies, the kind that wealthy people and smart entrepreneurs use all the time to keep more of what they earn and build real financial security. And here's the best part. You don't need to be rich to use these strategies. You just need to understand the rules and apply them the right way. So if you're ready to stop leaving money on the table, if you're ready to turn your tax situation from a burden into a blessing, then you're in the right place. Let's get started. Here's what we're going to cover today. And trust me, every single topic is designed to help you keep more money in your pocket. First, we'll break down how your filing status affects everything, from how much you owe to how much you can save. Then we'll dive into the Form 1040, what it really means, and how to navigate it like a pro instead of feeling lost and overwhelmed. Next, we'll explore the world of deductions, write-offs, and tax credits, the legal tools most people never use, but should. We'll talk about business tax benefits, even if you're just starting something part-time on the side. And finally, we'll show you how everyday people, just like you, can take simple, smart steps to turn taxes into opportunities. No jargon, no boring lectures, just clear, powerful strategies you can use right away. So if you've ever wondered why some people seem to win the money game while others struggle, the answer may be hiding in the tax code. Let's uncover it together. Let's start with something that sounds simple, but can have a big impact on your taxes. Your filing status. Now, most people just pick one and move on. Single, married, head of household. But here's the truth. Your filing status isn't just a box you check. It's a strategy. It affects your tax bracket. It determines your standard deduction. It even impacts which credits and benefits you qualify for, and choosing the right one, that can mean thousands of dollars in your favor. For example, did you know that filing as head of household, even if you're not married, can give you a higher deduction and lower your tax bill significantly? Or that married filing jointly isn't always the best option, especially if one spouse has major deductions or medical bills. This is the kind of stuff most people never think about. They just accept what their tax software spits out. But not you. You're here to get smart. Because when you file with strategy, you stop being at the mercy of the system and start using the system to your advantage. So don't underestimate this step. Your filing status is the foundation. Let's make sure you're standing on solid ground. Let's talk about a form that makes a lot of people nervous. But after today, you'll see it differently. It's called Form 1040. Now, before your eyes glaze over, stay with me. Because this form is not just paperwork. It's the story of your financial year. It shows what you earned, what you get to deduct, what the government owes you, or what you owe them. And here's the truth. Once you understand how this form works, you'll stop feeling overwhelmed and start feeling in control. Think of it like a scoreboard. It tells you how much of your income was actually taxable, which deductions and credits brought that number down, and how much tax you already paid versus how much you still need to. It's all there, clear, organized, 2 pages, no mystery, just math. And once you understand the flow of this form, you'll start to see exactly where your opportunities are. Where to lower your taxable income, where to claim credits, where to structure things differently next year. Because taxes aren't just about what happened last year, They're about what you're setting up for the future. And the 1040, that's your blueprint. Let's break it down, line by line, so you can start reading it like a financially savvy pro. All right, let's keep going with the 1040. Because the more you understand this form, the more confident and empowered you become. Think of it like a simple formula. Your income minus your adjustments minus your deductions equals your taxable income. Sounds simple, right? And it is, once you see the flow. First, we start with gross income. That's everything you earned. Then we subtract what's called adjustments for AGI. Things like retirement contributions, student loan interest, HSA deposits. What's left? That's your adjusted gross income, AGI. From there, you subtract either the standard deduction or your itemized deductions, whichever is larger. Then come tax credits, which directly reduce what you owe. And finally, the result, whether you still owe taxes or you're getting a refund. This isn't just paperwork. It's your chance to make the numbers work for you. Because every line on this form tells a story. And when you learn how to write that story strategically, you keep more money. You lower your stress. You plan smarter. So don't let the form intimidate you. Let it inspire you. Because when you master this, you're not just filing taxes. You're building financial awareness. Ready to go one layer deeper? Let's keep going. Let's go a little further, because now we're getting into the good stuff. You've figured out your income. You've taken your deductions. But now comes the power tools of tax savings, tax credits, withholding. Let me explain. Deductions reduce the amount of income you're taxed on. But credits, they directly reduce the amount of tax you owe, dollar for dollar. Think of it like this. If you owe $2,000 in taxes and you qualify for a $2,000 tax credit, you owe zero. That's the power of credits. There are credits for education, children, and dependents, energy efficient upgrades, retirement contributions, and more. And then there's withholding. That's the money already taken out of your paycheck throughout the year. When you combine these credits with what's already been withheld, you could be in line for a refund, or at least reduce your final tax bill significantly. Here's the big idea. Most people just file and hope, but smart people plan and position. And this form, Form 1040, is your scoreboard. Once you understand how each section works, you'll never look at tax season the same way again. So now that we've decoded the core form, let's zoom out and look at the big picture strategy. Because what you do before you file can make a bigger difference than what you do when filing. Let's go there next. Let's step back for a moment and look at the big picture of how taxes really work. Because once you see the full roadmap, everything starts to make sense. Here's how it flows. You start with your gross income. That's everything you made: salary, side gigs, tips, investments. Then come your adjustments. These bring you down to your adjusted gross income, or AGI. This includes retirement contributions, HSA deposits, and more. Next, you subtract either the standard deduction or your itemized deductions, whichever is higher. We'll talk more about how to choose in a moment. After that, you get your taxable income. That's what the IRS actually calculates your tax bill from. Then multiply by the tax rates. We'll explain the difference between marginal and effective rate shortly. But we're not done yet. Now you apply tax credits and subtract withholding, the tax you already paid. The result, your final tax bill or your refund. This isn't random. It's a step-by-step system. And when you understand each piece, you stop guessing and start controlling. This is how you go from feeling confused and reactive to feeling clear, confident, and in command of your money. Let me show you something that most people never learn, but once you see it, you'll never look at your income the same way again. It's the difference between your marginal tax rate and your effective tax rate. Now stay with me, because this one shift in understanding could literally save you thousands of dollars. Your effective tax rate is your average. It's what you paid overall as a percentage of your total income. Sounds harmless, right? But the real player, the one that actually affects how much tax you pay on every new dollar you earn, is your marginal tax rate. Let me show you how it works. Let's say you're married filing jointly in 2024. Your first $20,200 is taxed at 0%. Then up to $94,300 is taxed at 10%. Up to $201,050 is taxed at 12%. And as you go higher, you hit 22%, 24%, 32%, and even 35% or 37%. So here's the key insight. If you earn an extra $1,000 and you're already in the 35% bracket, that entire $1,000 gets taxed at 35%. That's $350 gone. And if you're in California, add another 9 to 13% state tax. You could be giving up $500 just to make $1,000. Think about that. You're working harder, but keeping less. Now here's where it gets powerful. If you understand how to use tax-deferred tools like a 401k, IRA, SEP IRA, you can avoid getting taxed at your highest bracket. That's like earning an instant 35–50% return without even investing in the market, just by keeping money in your pocket instead of sending it to the IRS. Want to lower your tax rate? Then shift your income timing. Accelerate deductions. Max out tax-deferred accounts. Be strategic about how and when you make money. Because here's the truth. Your effective rate is just a statistic, but your marginal rate is what's actually costing you. And if you learn to plan smart, you can save tens of thousands of dollars over your lifetime just by being proactive instead of reactive. Let that sink in. This is what tax-savvy people do, not just the rich. Anyone who's willing to learn can start winning. Let's now bring the concept of marginal tax rate to life with real numbers. Here are the official 2024 tax brackets. And whether you're filing as single or married filing jointly, you'll see the same pattern. The more you earn, the higher the rate on every new dollar. It starts at 10%, then jumps to 12%, 22%, 24%, all the way up to 37%. Now here's what most people miss. These brackets are progressive, which means not all of your income is taxed at the same rate. But every extra dollar you earn once you're in a higher bracket, that's taxed at your marginal rate. So if you're earning $201,000 as a couple filing jointly and you get a $10,000 bonus, you could lose $3,500 in federal taxes alone on that extra income. Add state tax, and suddenly half that bonus is gone. That's why tax planning is not optional, it's essential. With the right deductions, with smart timing, with tax-deferred accounts, and business write-offs, you can shift income out of high tax brackets and reduce how much tax you pay on every new dollar. This is how people earning six figures still pay less in taxes than someone earning much less, because they understand the system. So let me ask you, are you using the system, or is the system using you? Because without tax strategy, you're not just earning more, you're giving away more. But with strategy, you turn the IRS into a silent business partner, working for you, not against you. Let me ask you something. If you're investing, do you want to pay more tax or less? Because when it comes to your investments, how long you hold something can make all the difference. Here's the simple rule. Sell an investment within 1 year. Short-term gain. Hold it over a year before selling. Long-term gain. Now, why does this matter? Because short-term gains are taxed as ordinary income. That means your regular tax rate. 22%, 24%, 32%, 35%, even 37%. But long-term gains, they're taxed at special preferential rates, often 0%, 15%, or 20% depending on your income. That's a huge difference. Imagine earning $10,000 in gains. If it's short-term, you might pay over $3,000 in taxes. If it's long-term, you might pay only $1,500 or even zero. Let that sink in. Same investment, same profit, very different tax result just because of timing. So what's the takeaway? Your investment strategy needs a tax strategy. Don't just think about what to buy or sell, think about when. As Warren Buffett says, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Long-term investing isn't just smarter, it's more profitable after taxes. So before you hit sell, ask yourself, am I growing wealth or just giving it away in taxes? Let's keep going, because next, we'll show you how to choose between standard and itemized deductions to keep even more of what you've earned. Let me show you one of the easiest ways to keep more money in your pocket during tax season. Choosing the right type of deduction. Now here's the choice. Standard deduction. Simple, automatic, one size fits all. Itemized deduction. Customized based on your real life expenses. In 2024, the standard deduction is $350 if you're single. $27,700 if you're married filing jointly. Not bad, right? But what if your actual expenses, like medical bills, mortgage interest, property taxes, and charitable giving, add up to more than that? That's when itemizing could save you big. Let's break it down. Medical and dental expenses, over 7.5% of your income. State and local taxes, SALT, up to $10,000 home mortgage interest charity donations. Disaster losses in federally declared areas. If all of those total more than the standard deduction, you take the itemized deduction and keep more of your income. It's not about guessing, it's about comparing and choosing the larger number. Let me say that again. Don't choose based on habit. Don't choose based on what's faster. Choose based on what saves you the most money. Because that's what smart taxpayers do. So whether you own a home, donate to charity, or have high medical costs, itemizing might be the smarter path. And guess what? Even if you don't itemize this year, knowing how it works helps you plan for next year. You're no longer reacting. You're making strategic, empowered decisions. Ready to dive into one of the most misunderstood parts of the tax system? Let's talk about the alternative minimum tax. We talked about choosing between the standard deduction and itemized deductions. Now, let's go deeper, so you can see exactly what qualifies as an itemized deduction and decide whether it's the right move for you. Because here's the truth. Most people don't itemize, not because they shouldn't, but because they don't realize what they're allowed to deduct. Let's break it down. First, medical and dental expenses. You can deduct out-of-pocket costs, but only the portion that's more than 7.5% of your adjusted gross income. So if your income is high, you'll need significant medical expenses to qualify here. But for families with large medical bills, this is huge. Next, state and local taxes, often called SALT. This includes your state income tax and property tax. There's a cap, $10,000 total. Still, for many homeowners, that's a major deduction. Then there's mortgage interest. If you have a home loan of up to $750,000, you can deduct the interest you paid, especially valuable in your early years of owning. Charitable contributions also count. If you gave money or goods to qualified nonprofits, those donations are deductible, as long as you have receipts. And lastly, casualty or theft losses. These are rare, but if you live in an area that experienced a federally declared disaster, you may be able to deduct your uninsured losses. Here's the big idea. If you add up your qualified expenses and they're more than the standard deduction, you could lower your tax bill by thousands just by itemizing. So don't assume the standard deduction is always the better option. Run the numbers. Know your situation. Because when it comes to taxes, small details can lead to big savings. Up next, we'll explore how the alternative minimum tax fits into all this and what you can do if it applies to you. Now that we've talked about deductions and smart planning, there's one more tax concept you absolutely need to know. Because if you ignore it, it could wipe out everything you've done to reduce your tax bill. It's called the alternative minimum tax, AMT. Most people have never even heard of it. But if you're a high earner, or if you take a lot of deductions, this is something you cannot afford to overlook. Here's what it means. The government has a second tax system, yes, a backup plan, and its job is to make sure that even if you're using a lot of legal deductions, you still pay a minimum amount of tax. That's why it's called the alternative minimum, because it calculates your taxes all over again using different rules, and then charges you whichever number is higher. How does it work? It starts with your regular taxable income. Then it adds back certain deductions and preferences that are not allowed under the AMT system. Things like large state and local tax deductions, incentive stock options, or certain business write-offs. From there, it subtracts an AMT exemption, and then applies either a 26 or 28% flat rate. And if the result is more than your regular tax liability, guess what? You owe the difference. Even if you thought you had planned everything perfectly, AMT can come in and take a bigger slice. So what can you do? The first step is awareness, because once you understand how AMT works, you can structure your deductions and income differently to avoid triggering it unnecessarily. This is especially important for people with high incomes, large itemized deductions, stock options, significant business or investment activity. So don't let AMT sneak up on you. It's real, it's complex, but with the right planning, it's manageable. In the next section, we'll break down exactly what triggers AMT and how to stay one step ahead of it. Shall we move on? Let's go deeper into something we touched on earlier. Because if you're a high income earner, or if you use a lot of deductions, this could quietly undo everything you've done to lower your taxes. It's called the alternative minimum tax, AMT. Now you may be thinking, didn't we already cover this? Yes, but this time we're going to look at the numbers. Because starting in 2024, the AMT has new exemption amounts, and they matter. Here's how it breaks down. If you're single, your AMT exemption is $85,700. If you're married filing jointly, it's $133,300. Married filing separately, $66,650. So far, so good. But here's the catch. Those exemptions begin to phase out as your income rises. Once your income hits $609,305 as a single filer or $1.2 million as a married couple, your AMT protection starts shrinking. And remember, once you cross the AMT threshold, you get taxed at a flat rate. 26% on the first $227,000, then 28% above that. So what's the takeaway? Even if you've reduced your regular taxable income using legal deductions, AMT says, hold on, let's add some of that back in and run the numbers again. If the AMT number is higher than your normal tax bill, you'll owe the difference. No warning, no forgiveness. This is why high earners sometimes get hit with a surprise tax bill, even when they thought they did everything right. So how do you avoid it? Start by understanding your exposure. If your income is high, if you claim big deductions for state taxes, business write-offs, or equity-based compensation, you need to plan differently. AMT isn't about doing something wrong. It's about knowing the second set of rules and playing smart. Coming up next, we'll show you what triggers AMT and how to avoid stepping into it without even knowing. So now you know what AMT is, but the next question is even more important. What actually triggers it? Because AMT doesn't come out of nowhere. It's caused by specific income types, deductions, and tax decisions. And if you know what those are, you can plan ahead and avoid getting blindsided. Let's walk through it step by step. AMT starts by taking your regular taxable income, then adds back certain adjustments and preferences, basically deductions the AMT system doesn't allow. Here are some common triggers. High state and local tax deductions like income or property tax, large miscellaneous itemized deductions, exercising incentive stock options, ISOs, high personal exemptions, if still applicable under prior year structures, depreciation methods used in business or real estate, tax-exempt interest from private activity bonds. Once those items are added back in, you arrive at a new number called Alternative Minimum Taxable Income, AMTI. From there, you subtract the AMT exemption and apply the AMT flat rate, 26 or 28%. If that number is higher than your regular tax bill, you pay the difference. Here's the big idea. You might be doing everything right, maximizing deductions, making smart investments, growing your income, and still get penalized by AMT. That's why proactive tax planning matters. If you live in a high-tax state, own real estate or a business, have equity compensation or stock options, or plan to itemize aggressively, then you need to consider how your choices could impact AMT. It's not about being scared, it's about being prepared. Up next, we'll shift gears and look at one of the most powerful tools for entrepreneurs, business write-offs. Even part-time business owners can access major deductions. Let's explore how that works next. Let's now bring everything together and make AMT simple to understand with a step-by-step formula. Because even though the rules sound technical, the logic is actually straightforward once you see it laid out. Here's how AMT is calculated. Step 1, start with your regular taxable income. Step 2, add back adjustments and tax preference items. These are things the AMT doesn't allow, like large state tax deductions, incentive stock options, and certain types of depreciation or interest. Step 3, you now have something called Alternative Minimum Taxable Income, or AMTI. Step 4, subtract the AMT exemption based on your filing status. Step 5, apply the AMT flat tax rate, 26% on the first portion, 28% on income above the threshold. That gives you your tentative AMT. Then subtract any AMT foreign tax credit you qualify for. Now compare that number to your regular tax from the 1040. If your AMT number is higher, you owe the difference. That's AMT in a nutshell. It's not meant to replace your normal tax calculation. It's a parallel system designed to make sure high earners still pay a minimum amount. So what does this mean for you? If your income is growing, if you're using smart deductions, if you have investments or equity-based compensation, you need to run both calculations in your planning, not just the regular tax. Because the only thing worse than overpaying taxes is planning carefully all year, only to find out the IRS has a second set of rules you didn't prepare for. Up next, we'll shift focus and show you how business owners, even part-timers, can unlock powerful tax advantages through Schedule C write-offs. Now let's talk about something that can completely transform your tax life. It's the power of a business write-off. Here's the truth. As a regular W-2 employee, you have almost no control over your taxes. You get paid, the IRS takes their cut, and you live on what's left. But once you start even a small side business, everything changes. Because as a 1099 independent contractor or self-employed person, you gain access to an entirely different section of the tax code. And that's where the magic happens. Now you can legally write off expenses that employees never could. Let me give you some examples. Your phone bill. Part of it is now a business tool. Internet at home, used for Zooms and emails, deductible. Driving to appointments or trainings? Mileage adds up fast. Business meals, marketing costs, office supplies, all deductible. Even a portion of your rent or utilities if you work from home. This isn't a loophole. This is the way the system is designed. The government wants people to start businesses because entrepreneurs create jobs, drive innovation, and stimulate the economy. So they give you powerful tax tools if you know how to use them. And here's the best part. You don't need a storefront. You don't need to quit your job. You don't need to be a full-time CEO. You just need to have a business, something with intent to generate income, even part-time, even from home. That opens the door to deductions, savings, and a whole new level of tax efficiency. So ask yourself, if you could turn your everyday expenses into tax savings, why wouldn't you? Coming up next, we'll look at the form that makes it all official. Schedule C, your path to legal, strategic, smart tax write-offs. Let's talk about one of the most powerful, but often misunderstood tools for building tax-efficient income. Schedule C. This is the form that makes your business. Any business, big or small, official in the eyes of the IRS. And when you file Schedule C, you unlock something incredibly valuable. The ability to report your business income and deduct your business expenses, all in one place. Here's how it fits into your tax return. First, on Form 1040 Schedule 1, you'll list any additional income, like freelance work, consulting, side hustles, or small business activity. Then you attach Schedule C. That's where the real strategy begins. Schedule C allows you to report your gross income from business, subtract your operating expenses, and calculate your net profit or loss. Only that final number, the net, is what gets passed to your main tax form and potentially taxed. So what does this mean? It means every expense you legally record here can reduce your taxable income. Let's say you earned $20,000 from a side business, but you had $8,000 in legitimate expenses. Phone, internet, travel, software, training, even part of your rent. You don't get taxed on $20,000. You only get taxed on $12,000. That's the power of Schedule C. And guess what? If you're just starting out and your expenses are more than your income, you can even claim a loss, which may reduce your overall tax burden from your W-2 job. This isn't just tax filing, it's tax design. It's how everyday people start thinking and winning like entrepreneurs. Next, we'll walk through the key sections of Schedule C so you know exactly how to use it to your advantage. Let's walk through the first part of Schedule C, because this is where your journey as a tax-savvy entrepreneur officially begins. It's called Part 1, Business Information and Income. And don't worry, this isn't complicated. In fact, most of it is just filling in basic facts about your business. Even if you're just getting started or running something part-time, this still applies to you. Step 1, business information. You'll enter things like business name. If you don't have one, no problem. Just leave it blank and use your personal name. Business type. What do you do? Insurance agent, consultant, freelancer, e-commerce seller. Just describe it simply. Business address. If you work from home, just put your home address. Accounting method. Most people use cash basis, which means you count income when you receive it and expenses when you pay them. Did you hire contractors? If you paid freelancers or outside help and sent them a 1099, check yes. If not, no is fine. That's it. You're telling the IRS, this is my business, this is how I operate. And once that's on paper, you've opened the door to a whole new set of tax-saving tools. Step 2, business income. Now you list what your business brought in. Gross receipts or sales, that's the total amount you made from products or services. Returns and allowances. If you gave a refund or discount, subtract it here. Other income. This might include fuel tax credits, grants, subsidies, or reimbursements. Now here's what most people don't realize. Even if your business made zero income, you can and should still file Schedule C. Why? Because your expenses still count. And those expenses could lower your total tax bill from other sources of income. You're not required to be profitable in year one. The IRS understands that businesses take time to grow. What matters is that you're treating it like a real business. So this part one, is about laying the foundation. It's simple, it's straightforward, and it sets you up for real tax advantages. Next, we'll go to the most exciting part two, business expenses, where we start reducing your taxable income line by line. Shall we continue? Now we've arrived at the part everyone loves, the write-offs. This is part 2 of Schedule C, where you legally deduct your business expenses and lower the amount of income the IRS can tax. This is the section that puts real money back in your pocket. And here's the good news. Even if you're running a small side business from home, you may qualify for more deductions than you think. Let's go through the most common categories. Advertising. Promoting your business is deductible. That includes Google and Facebook ads, business cards and flyers, social media campaigns, website branding, car and truck expenses. If you drive to meet clients or attend business events, you've got two choices. Use the standard mileage rate, 67 cents per mile in 2024, or track actual costs, fuel, insurance, repairs, depreciation. Either way, your business use of a car can lead to big savings. Insurance protecting your business is a write-off too. Errors and omissions insurance, liability coverage, industry-specific coverage, legal and professional services. Did you pay for tax help, legal advice, or business coaching? Accountants, contract attorneys, financial consultants, all deductible. Office expenses, whether you rent a space or work from home, office rent or co-working memberships, laptops, printers, software, desks, chairs, pens, paper, it adds up fast. Licenses and permits. Any license or registration required to operate your business counts. Insurance or real estate license, local business registration fees, travel and meals. If you travel for business purposes, like conferences, client meetings, or training, flights, hotels, taxis, all deductible under travel. Business meals, you can usually deduct 50%. Other expenses, here's where most people miss out because they don't think it counts. Internet and cell phone, business portion. Professional training and certifications. Business gifts, up to $25 per client. Branded apparel. Website hosting and domain fees. Memberships in industry groups. Office supplies, yes, even your whiteboard markers. Here's the point. Every dollar you spend on your business could be a dollar you don't have to pay taxes on. And even if your business hasn't made a profit yet, these expenses can offset income from your full-time job, which means you pay less overall tax. W-2 employees don't get access to this, but you do because you're an entrepreneur, and that comes with tax advantages. So don't miss out. Track your expenses, organize your receipts, file your deductions with confidence. This is how smart people lower their taxes and build real financial leverage. Next up, we'll look at a sample Schedule C, so you can see exactly how this plays out on paper. Now let's bring it all to life with a real-world example, because theory is one thing. But when you see how Schedule C works in action, you realize just how powerful it really is. Here's a case study of someone who started a new business, licensed, launched, and operating on a small scale. And even though their first-year income was low, they still used Schedule C to reduce taxes and claim a potential refund. Let's break it down. Part 1, income, $0. This entrepreneur reported zero gross income. That's right, nothing earned yet. But here's the key. You don't need income to claim legitimate business expenses. Why? Because you're building, you're investing, you're operating with intent. Part 2, business expenses. Here's what they deducted. Advertising, $1,000. Created a TikTok business page, ran Facebook and Google ads, ordered business cards and promo materials. Car and truck expenses, $8,000. Traveled for meetings and recruiting. Tracked 12,000 business miles. At 67 cents per mile, that's about $8,000 in deductions. Business insurance, $650 could be. Errors and omissions coverage, general liability policy. Professional services, $700. Hired a CPA for tax help. Paid an attorney for contract review. Office expenses, $5,000. Claimed home office deduction, 20% of home used for business. Bought a laptop, printer, router, and office furniture. Licenses and taxes, $450. Business license. Industry-specific registration fees. Travel, $8,000. Flights and hotels for industry conferences and training. Local transportation for client visits. Meals, $5,200. Client meetings and networking dinners. 50% of those expenses were deductible. Other business expenses, $1,000. Internet and phone, business use. Website domain and hosting, continuing education and books. Membership in professional groups, branded shirts with company logo. Total expenses, $30,000. Income, $0. So net business loss, $30,000. And here's the magic. That $30,000 business loss, it can offset W-2 wages or investment income and potentially reduce the overall tax bill or generate a refund. This is how even a brand new business can create immediate financial impact, not by making money on day one, but by being smart with how it invests and operates. Entrepreneurship isn't just about income, it's also about access to tax advantages that employees simply don't have. So if you're starting out, don't wait until you're profitable to file Schedule C. Start now. Track your expenses. Use the system the way it was designed. In the next section, we'll talk about how to keep your business running lean and maximize your deductions as you grow. Before we compare tax burdens between W-2 employees and entrepreneurs, there's one more powerful benefit you need to know about. It's called the Qualified Business Income Deduction, or QBI. And if you're a business owner, whether full-time or part-time, this could put thousands of dollars back in your pocket every year. So what is QBI? It's a tax break created specifically for small business owners. If you qualify, the government lets you deduct 20% of your business profit before you even calculate your taxes. That means less taxable income and more savings. Let's say your business made $100,000 in profit. With QBI, you can deduct $20,000 right off the top. You're only taxed on the remaining $80,000. W-2 employees, they don't get this deduction at all. Here's who qualifies: 1099 independent contractors, sole proprietors, filing Schedule C, LLCs, S-corp, and partnerships. Most pass-through entities, and who doesn't? W-2 employees, anyone earning income only from traditional jobs. This is a game changer. Let's talk about income limits. In 2024, you qualify for the full 20% deduction if your taxable income is $197,500 or less if you're single, $381,500 or less if married filing jointly. If your income is higher than that, the QBI deduction starts phasing out and eventually disappears entirely beyond certain thresholds. So what's the big takeaway? If you're a W-2 employee, you pay full tax on every dollar you earn. But if you own a business, even a part-time one, you could legally deduct 20% of your profits, plus all your other business expenses. That's not a small advantage. That's a whole different tax reality. So if you're wondering whether it's worth it to start your own business, this is one more reason why the answer might be yes. Because tax laws are written to reward entrepreneurship, not employment. Next, we'll compare side by side W-2 employee versus part-time entrepreneur versus full-time business owner. And you'll see clearly why starting your own business might be the smartest financial move you can make. Let's take a look at a very common tax scenario. Someone who has a solid job, earns a decent income, but doesn't have a side business. They're a W-2 employee. No outside income, no tax strategy, no write-offs. Here's what their tax picture looks like. Total income, $124,600. This person has no 1099 income, no investments, no business. So their income is 100% from their job. Adjusted gross income, $124,600. There are no adjustments, no retirement deductions, no HSA, nothing to reduce it. Standard deduction, $14,600. They don't own a home. No major medical expenses, no charitable giving. So they just take the standard deduction. QBI deduction, 0. Remember, W-2 employees are not eligible for the 20% qualified business income deduction. This is only for independent contractors and business owners. Taxable income, $110,000. That's what the IRS will tax. No way to reduce it further. Now let's pause here for a second. This person is working hard, making six figures, and yet they have zero tax flexibility. They can't deduct a phone bill. They can't deduct mileage. They can't even write off a business meal. They're doing everything right in the traditional sense. But the system simply wasn't designed to reward employees the way it rewards entrepreneurs. And here's the thing. This could be anyone. Maybe it's you. Maybe it's someone you know. But here's the exciting part. You don't have to quit your job to change your tax picture. You just need to start something on the side. Become a part-time independent partner with us. Begin building your own small business, even if it's just a few hours a week. Because once you do, everything changes. You unlock business deductions. You gain access to the QBI deduction. You shift from full taxation to smart taxation. And over time, maybe even full-time entrepreneurship becomes an option. In the next section, we'll compare what happens when someone does start a side business. Same income level, but a very different tax outcome. Are you ready to see the difference? Now let's see what happens when someone, just like the W-2 employee we discussed earlier, makes one small change. They start a part-time business, same W-2 job, same $124,600 in income. But now, they've taken a step toward independence, maybe through our platform, maybe just a few hours a week, and they've officially launched their business. And even though they didn't make any income in their first year, they're still able to file Schedule C and deduct $30,000 in legitimate business expenses. Let's look at how that changes everything. Step 1, total income. W-2 income, $124,600. Schedule C business loss, $30,000. Total income, line 9, $94,600. Step 2, adjusted gross income, AGI. No other adjustments, so AGI, $94,600. Step 3, standard deduction. Same $14,600 standard deduction. Step 4, QBI deduction. Because the business is operating at a loss, there's no QBI this year, but that's okay. The real benefit is still massive. Final taxable income, $94,600, $14,600, shared $80,000. Now let's compare. The W-2 only employee we saw before, taxable income, $110,000. The part-time entrepreneur, taxable income, $80,000. That's a $30,000 reduction. Same job, same salary, but because they took action and started a business, they unlocked write-offs that W-2 employees simply don't get. Let's break it down even further. That $30,000 in business deductions came from using a personal car for business travel, writing off part of a cell phone or internet bill, dedicating space at home as a business office, going to industry training, client lunches, networking events, investing in business tools, branding, and education. Things they were already doing. But now they're doing it with a tax advantage. And here's the most exciting part. They didn't have to quit their job. They didn't have to be full-time. They didn't even have to make a profit yet. They simply started. That one move, becoming a part-time independent partner with us, completely changed their tax reality. So if you're wondering, can I really lower my taxes? Can I really start small? Can I do this without quitting my job? The answer is yes. And we can help you do it. Next, we'll take it one step further. What happens when you go full-time as a business owner? You're about to see what's truly possible. Now we've come to the final comparison, and it just might change the way you think about income, taxes, and your future. Let's look at someone who earns the same $124,600, but this time they're a full-time entrepreneur. No W-2 job, no boss, just their own business, maybe consulting, selling, recruiting, or coaching. And they've chosen to build it through a 1099 or Schedule C structure. Here's what their tax picture looks like. Step 1, total income. W-2 wages, though. Business income, Schedule C, $124,600. Business deductions, $30,000. Adjusted income, $94,600. Step 2, adjusted gross income, AGI. No other adjustments, so AGI stays at $94,600. Step 3, standard deduction. Same single filer deduction, $14,600. Step 4, QBI deduction. Here's where it gets powerful. They qualify for the qualified business income deduction. QBI, 20% of $94,600, $18,920. Final taxable income, $94,600, $14,600, $18,120, $61,080. Now compare that to our previous examples. W-2 employee, taxable income, $110,000. Part-time entrepreneur, taxable income, $80,000. Full-time entrepreneur, taxable income, $61,080. Same total income, very different tax outcome. Why? Because the tax code wasn't written to favor employees. It was written to encourage entrepreneurship. And the IRS rewards business owners, especially those who take the leap and go full-time, with tools like write-offs, QBI, and long-term tax strategy. But here's the best part. You don't have to start full-time to benefit. Even part-time partners in our system can deduct real business expenses, lower their taxable income, start building assets instead of just earning wages, and eventually, if they choose, scale into full-time business ownership. We're not saying quit your job tomorrow. We're saying get in the game, start small, start now. Because when you work with us, you don't just start a business, you start a smarter life. Next, we'll show you exactly what kinds of expenses you can write off and how to start claiming your tax advantages right away. What we've been talking about today isn't just about tax savings. It's about something much bigger. It's about taking control of your income, your time, and your future, and ultimately unlocking financial freedom. This idea comes straight from Robert Kiyosaki's Rich Dad Poor Dad and his famous cash flow quadrant. He divides income into 4 categories. Quadrant 1, E, employee. You have a job. You trade time for money. Your taxes are taken out before you ever see your paycheck, and your ability to grow is limited because time and energy are limited. You might feel secure, but you're not building real freedom. Quadrant 2, S, self-employed, independent professional. You don't have a boss, you are the boss, but you're still exchanging time for income. You do get access to better tax strategies, like Schedule C deductions, solo 401ks, and SEP IRAs. But the moment you stop working, the income stops too. There's still no leverage and no system. Sound familiar? Maybe you're in the E or S quadrant right now, just working harder and trying to save more. But here's the truth. Working harder won't set you free. Building smarter will. And that brings us to quadrant 3, B, business owner. You own a system. You lead a team. You no longer earn only when you work, because now your system works even when you don't. You get massive tax flexibility. You can structure income through an S Corp or LLC, deduct salaries, rent, equipment, and team building costs. You can offer retirement benefits for your team and for yourself. You create leverage. You gain time. And finally, quadrant 4, I, investor. Your money works for you. You earn from capital gains, dividends, real estate, and equity. And here's the best part. You're taxed at some of the lowest rates in the entire system. This is where wealth begins to multiply. Now ask yourself honestly, where are you right now? And where do you want to be? If you're still in the E or S quadrant, this is your chance to upgrade. You don't have to leap all the way to quadrant B or I overnight. You just have to start. And that's exactly what we offer. A path to begin as a part-time independent partner with the training, tools, and system to help you grow, whether you stay part-time or go full-time. From there, you'll build your own business, gain tax advantages, and eventually unlock true freedom. Because tax planning isn't just a way to save money, it's a tool to accelerate your journey toward wealth. So the question isn't, can I do this? It's, when will I start? We're here to walk with you every step of the way. Let's be honest. At this point, you might be thinking, this all makes sense, but starting a business still feels scary, and you're not alone. Most people want to start something of their own, but never do, because they run into one or more of these 6 obstacles. 1, capital. You think, I don't have tens of thousands of dollars to invest. Traditional businesses can be expensive, but we're not doing traditional. Our model helps you start with minimal cost, minimal risk, and a proven system. 2, experience. You wonder, I've never done this before. Where would I even start? Good news, you don't need prior experience. We provide the blueprint, the training, the mentorship. You follow a step-by-step system built for beginners. 3, marketable idea. You worry, what if no one wants what I offer? But here, you're not inventing a product from scratch. We're in one of the most stable, recession-proof industries, financial protection, with real demand every day. 4, security. You say, I can't quit my job. I have bills to pay. You don't have to. This is designed to be a part-time opportunity you build on the side until you're ready, or not, to go full-time. 5, leadership. You're unsure. I'm not a natural leader. Can I really build a team? Yes, because leadership isn't something you're born with. It's something we teach, support, and grow together. Monster 6, fear of failure. This is the big one. What if I try and it doesn't work? But here's the real question. What if you don't try and stay stuck where you are? What if you miss the chance to build freedom, impact, and wealth because fear won? We believe you're capable of more, and our system is built to help you succeed with training, mentorship, support, and a team that won't let you do this alone. You're not starting from scratch. You're starting with a partner, whether it's part-time, full-time, or step-by-step at your pace. We're here to help you make the move, from W-2 to 1099, from employee to entrepreneur. You don't have to be perfect. You just have to be willing. By now, you might be thinking, this sounds amazing, but how exactly can I start? That's where our platform comes in. Because we've built a system specifically designed to help everyday people, just like you, launch a real business with confidence, with support, and with very low risk. Here's what makes us different. 1. No major investment needed. You don't need tens of thousands to open a franchise. You just need to get your insurance license, and we'll help you do that. Once licensed, you can start earning while you learn, so your business pays for itself. 2. $0 to join. No franchise fees. No huge upfront cost. You join for free, and we help you get appointed by major insurance companies. That means your startup cost is next to nothing, but your upside is unlimited. 3. No job risk. Start part-time. Keep your current job. Keep your current income. Start with us on the side, build your business gradually, and when you're ready, you can choose whether to go full-time. You stay in control. 4. No experience required, never sold insurance before, never led a team? No problem. We provide full training, professional scripts, tools, videos, and most importantly, mentorship from real leaders who've done it before, and will walk with you step by step. 5. Flexible schedule. This is your business. You choose your hours. Perfect for working professionals, stay-at-home parents, retirees, or anyone wanting more freedom, whether it's evenings, weekends, or pockets of time throughout the week. You decide how to build it. 6. Unlimited territory. Unlike a local franchise, your business isn't tied to a zip code. You can build it anywhere, online or offline. You can have clients in California, Florida, New York, or beyond. No limits, no borders. 7. Unlimited advancement. There's no corporate ceiling here. Your title, your income, your growth are all based on your effort. You can start solo and grow into a team leader, a regional director, or even build your own nationwide agency. And the best part? You're not doing it alone. You're joining a family, a system, a movement, a place where your effort is valued. Your goals are supported, and your dreams are taken seriously. So if you've ever wanted to start something of your own, without all the traditional risk, this is your invitation. Start part-time, build full-time freedom with us. Some people ask us, do you only help with tax planning? The answer is absolutely not. Tax planning is just the beginning. What we really do is help people understand wealth. We help families learn how to protect, grow, and transfer wealth so they can build a future they truly own. And that starts with understanding one key truth. Wealth isn't built by accident. It's built by strategy. And we help deliver that strategy. Let's look at the big picture. From 1926 to 2023, if you had invested just $1, here's what would have happened. In small stocks, that $1 could have grown to 49,052's 11.8% AVG return. In large stocks, $1 becomes 11,535. In government bonds, $1 becomes 131. In treasury bills, just 22. And with inflation at 2.9% annually, that same $1 only worth $7 in real value. So what's the message? If you only hold cash or safe assets, you're actually losing ground over time. But when you invest wisely, consistently, and long-term, you give your money the power to multiply. Of course, investing isn't a straight line. There have been downturns. The Great Depression, W2, the 2008 financial crisis, COVID. Even last month, the S&P dropped 8% and NASDAQ over 11%. But the people who succeed? They don't panic. They plan. They stay in the game and position themselves for long-term growth. And that's where we come in. We are not just tax planners. We are financial educators. We are protection strategists. We are wealth architects. We help clients build strong, diversified portfolios, stocks, bonds, insurance, real estate, annuities. Use tools like Roth IRAs, 401ks, and tax-deferred vehicles. Avoid emotional investing mistakes. Stay focused on long-term results. And yes, minimize taxes while maximizing growth. Because true financial freedom doesn't come from luck or timing. It comes from a clear strategy and a team that supports you. And if you're thinking about joining us as a part-time independent partner, or even going full-time into this powerful industry, you won't just be selling a product. You'll be delivering peace of mind. You'll be building your own legacy while helping others build theirs. You'll be doing meaningful work in a high trust, high impact, high reward profession. This isn't just a business, it's a calling, and we'd be honored to help you get started. Earlier, we showed you how powerful long-term investing can be. $1 turning into $49,000 over decades. Those numbers are real. But let's not sugarcoat it. Short-term risk is real too. In just the past month, NASDAQ dropped over 11%, S&P 500 down 8%, Dow Jones swinging wildly. If your portfolio is exposed to this kind of volatility, what happens to your long-term plans? Here's a simple truth about investing that most people never realize. Losses hurt more than gains help. Let me explain with two quick examples. You start with $100. It drops 50%. You now have $50. Then it grows 50%. You're back to only 75. You're not even back to break even. Same if you reverse it. Grow first, drop later. You still end up at 75s, not $100. Why? Because when you lose, you have to work harder to recover. And that's why one of the greatest investors of all time, Warren Buffett, said it best. Rule number one, never lose money. Rule number two, never forget rule number one. So here's the real question. How do we protect ourselves? How do we grow our wealth without exposing it to devastating losses? That's exactly what we help clients do. We don't just talk about returns. We design strategies that prioritize protection first. Principal protected solutions that grow with the market, but don't lose when it crashes. Insurance-based investments that safeguard capital while offering upside potential. Diversified portfolios built with stability, income, and longevity in mind. Tax-efficient structures that reduce risk from Uncle Sam, too. We help clients sleep at night, even when the market's not. Because real financial success isn't just about how much you make, it's about how much you keep. And if you're thinking about joining us, part-time or full-time, you won't just be helping others grow wealth. You'll be helping them protect legacies. That's not just a career, that's a calling. In the next few pages, we'll show you the exact tools and write-offs our partners enjoy. Real savings, real results, real stories. So far, we've covered how long-term investing builds wealth and how short-term losses can destroy momentum. Now let's ask the real question. Is there a way to enjoy the upside of the market without suffering the downside? Yes, it's called IUL, Indexed Universal Life. And this is one of the smartest tools we use to help clients grow and protect wealth at the same time. So what exactly is IUL? IUL is not just life insurance. It's a powerful financial vehicle that combines growth potential tied to market indexes like the S&P 500, principal protection with a guaranteed 0% floor, tax advantages that keep more wealth in your hands, flexible access to cash for retirement, college, or emergencies. Let's break it down. 1. Protection from loss. When the market goes down, your IUL does not lose money. That's right. Your returns never go below 0%. While others are watching their investments crash, your account value holds steady. We call that zero is your hero. 2. Growth with market upside. When the market rises, your IUL captures part of that growth, often up to a cap of 10 to 15% per year, depending on the policy. You don't get the full 20% bull market return, but you also never take a loss. And over time, that balance of growth plus protection adds up in your favor. 3. Power of compounding. Because IUL protects your gains every year, you don't waste time recovering from losses. You're always building on top of your last high point. That's how compound growth truly works. And remember, IUL is not a Wall Street gamble. It's a long-term strategy backed by A+ rated companies designed for families who want to build wealth with confidence. Now here's where we come in. As one of the top 1% general agencies nationwide, we're appointed with every major A+ carrier. That means we help clients choose the best IUL products on the market, customized for their goals, risk tolerance, and long-term plans. And if you choose to work with us, whether part-time or full-time, you won't just be selling policies. You'll be helping families protect their future, guiding clients through one of life's most important decisions, building your own business in a respected high-trust industry, creating lasting income in a career that actually means something. This is where tax planning, financial strategy, and legacy protection come together. This is what we do. In the next slide, we'll show you how IUL also provides powerful tax advantages, helping you keep more of what you earn and pass it on smarter. Let's talk about one of the most powerful benefits of the IUL strategy: taxes, or more accurately, the lack of them. In the US, the IRS gives you only 3 choices when it comes to how your money gets taxed. And once you understand these 3, you'll understand why IUL is in a league of its own. The 3 tax buckets. 1. Tax. Now, this includes your bank accounts, brokerage accounts, and investments. You earn interest, dividends, or capital gains, and get taxed every year. You're basically sharing your profits with the IRS every single time. The longer you invest here, the more taxes eat away your returns. 2. Tax later. This includes your 401k, traditional IRA, and 403b. You defer taxes now, but you'll pay taxes on everything when you retire. Yes, your money grows tax deferred. But when you withdraw it, every dollar is taxable, even the growth, even if tax rates are higher in retirement. 3. Tax never. This is where IUL stands tall, alongside Roth IRAs and Roth 401ks. Your money grows tax-free, and you can withdraw it tax-free, legally, compliantly, IRS-approved. But here's the real difference. Unlike Roth IRAs and 401ks, IUL has no income limits, no contribution caps, no required withdrawal age, no penalties for early access, no restrictions on how or when you use the funds. Let that sink in. You're not just building wealth. You're building accessible, protected, and tax-free wealth. And because IUL is built on a life insurance chassis, your retirement withdrawals don't count against your Social Security or Medicare thresholds. That means more income in your pocket and less lost to hidden taxes or penalties. This is why more and more smart professionals, business owners, and even doctors and lawyers are adding IUL to their financial strategy. And this is what we do every single day. We teach families how to legally stop overpaying taxes. We guide professionals in building tax-free retirement income. We show part-time partners how to leverage IUL to help others while building their own business. And if you're looking for a purpose-driven career, one where you're doing meaningful work in a respected industry with unlimited upside, this is it. You're not just sharing a product. You're sharing a smarter way to build wealth while creating wealth for yourself. That's what we do. And that's why we'd love for you to join us as a part-time independent partner or full-time entrepreneur. Thank you for giving yourself this hour. Thank you for being open to learning, growing, and thinking differently. I hope today's session opened your eyes to just how much smarter your money can work for you through tax strategy, long-term investing, risk protection, and most importantly, a clear financial roadmap. But let's be honest, knowledge only changes lives when you take action. So the question now is, what's your next step? We offer 2 clear paths forward, depending on your needs and your goals. Path 1, one-on-one financial strategy session. If you want help with reducing this year's taxes, building a long-term financial plan, creating tax-free retirement income, protecting your family with smarter insurance, or simply getting your questions answered, then scan the left side QR code now. Book your free 30-minute personalized consultation. No sales pitch, just real help from real professionals. Let us help you turn today's ideas into real, tangible results. Path 2, build something of your own. If you felt inspired today, if you're looking for more income, more flexibility, or a more meaningful career, then this is your moment. Join us as a part-time independent partner, or go all in full-time. You don't need capital. You don't need experience. You just need the desire to grow and a willingness to start. Here's what you'll get. $0 to join. No franchise fees. No job risk. Start part-time. No experience required. Full mentorship included. Flexible schedule. Build it your way. Unlimited territory. Build locally or nationally. Unlimited advancement. You control your ceiling. Scan the right side QR code to apply for our free membership today. You'll unlock access to more trainings, tools, and a guided launch plan to help you build your own financial business from scratch. And let me give you one last truth. Big decisions rarely happen in group settings. That's why we strongly encourage you to book a one-on-one conversation with the person who invited you today. Because whether you become our client or our partner, that private session is where your real breakthrough begins. And if you already know this is right for you, Don't wait. Apply now. Join our community. Start building your new chapter. You truly have nothing to lose and everything to gain. We can't wait to walk this journey with you.
Legal disclaimer. The content presented in this video is for educational and informational purposes only. It does not constitute legal, tax, or investment advice, nor should it be considered a recommendation or guarantee of any kind. Viewing this video does not establish a client relationship, and no part of the video should be interpreted as a personalized tax filing strategy, investment recommendation, or contractual offer. We are sharing stories and examples based on real-life experiences of our part-time and full-time partners, illustrating how they may benefit from existing IRS rules and the U.S. tax code when operating as independent contractors. All tax-saving strategies discussed are derived from publicly available tax laws and regulations, particularly those applicable to 1099 self-employed individuals. We encourage viewers to consult with licensed tax professionals or financial advisors before making any financial decisions. We are deeply grateful to the IRS and the U.S. tax code for creating opportunities that empower everyday people to build businesses, support their families, and serve their communities. This presentation reflects our mission to grow, serve, and invite more partners to join us in bringing peace of mind to every household we reach. Thank you for watching and learning with us.